What's up everybody, Nate here, and the United States is currently undergoing one of the biggest financial flips of our generation. You have sky-high record inflation going up every single month, and at the same time you have major markets all throughout the country essentially tanking. That has left many Americans to worry about if a recession is around the corner or if we currently are in a recession. Now, if you look at all of the mainstream traditional media outlets, they are going to tell you that pretty much everything is a recession indicator, from yield prices to guac prices, metals, burgers, and just about everything else. But today I want to talk about the biggest and most unorthodox recession indicator that we have, the auto market. Over the last 2 years, the auto market has exploded, with car prices going up nearly 40, 50, and 60% for pretty much new and used vehicles alike. That is something that we really haven't seen in the United States ever before. But now that market is starting to flip on its side, and with this market essentially going down, that could mean a whole lot of bad is coming to the United States economy in 2022, and it could mean that we are headed for a recession. So today I want to talk about the major changes currently happening in the car market and how that can pretty much predict what is going to happen for the future of our economy. So let's go ahead and jump into it. Right now in the United States, we have car repossessions growing all throughout the country. That means that people are pretty much unable to make their payments for their used or new vehicles, and whoever loaned them the car and they had to borrow money from is now taking that vehicle as collateral. At the same time, you have new and used vehicle prices plummeting in the United States. They are going down on average around 25%, meaning that demand for both of those things are going down across the board. Now, what exactly is going on here? So during the early days of the pandemic, all the way back in 2020, it feels like a lifetime ago, used vehicles and new vehicles were kind of a hot commodity, and the reason being is for two major reasons. For one, the United States federal government was printing a ton of money, so people went out and spent a lot of this additional income on vehicles. They got a new car or they sold their vehicle and got another used vehicle. Whatever the case, people were spending money on cars. Not only that, but interest rates for the Federal Reserve were dropping to nearly 0%. That made it really easy for a lot of Americans to go out and spend their money on a new vehicle or on a used vehicle. Now, at first, this wasn't a big deal because we didn't see an explosion in the auto market right away, but by the mid parts of 2021, the auto market and car market essentially exploded. People went out and bought so many cars over the last 2 years that chip manufacturers and car companies just could not keep up with supply. A lot of the vehicles that are sold here in the United States, a lot of the manufacturing is done overseas, and a lot of the resources that we use for car chips, which are basically the brains of the vehicles, we simply could not get. That created a lag in the supply chains, and well, car prices went up because demand was going way up, but the supply we had was decreasing. I had a few friends and family that went out to actually try to get a new car during 2020 and in 2021, and they were telling them that it could be a year for them to get their vehicle, and the only thing that you could buy was what they had on the lot. If you wanted to order something, whether it was from the big three or from Tesla, you had to wait for it. All that did was send the price of vehicles way up again, meaning we just had way too much demand in the market. But now in 2022, things have started to improve from the supply chain side. A lot of your car manufacturers and your producers are starting to make more vehicles. They're getting more resources to actually start creating the cars. And we're having a lot less chip problems too, so that means that more vehicles can be made a lot faster. That is all great, except for when you consider the United States is in a very different place financially than we were back in 2020 and in 2021. For one, there's a lot less money going around because the Federal Reserve has finally turned off the money printer. There is not as much economic stimulus, so Americans can't go out and buy a car as easily as they could back in 2020 and in 2021. Not only that, but remember those interest rates that went down to 0% back in 2020? Well, now they are starting to go up once again, the Federal Reserve has raised its benchmark interest rates 3 times in 2022 and is poised to do it more times throughout the rest of this year. That means that your typical auto loan is getting a lot more expensive, and cars are still pretty valuable because while supply chains have improved, well, they haven't improved enough to completely meet up with where demand is. So you have a situation where cars are getting more expensive and the loans to actually get the cars are getting more expensive, all while Americans are making a whole lot less money than they were just 2 years ago. Now, this is where car repossession numbers come into play in 2022. When you have a situation where millions of cars are being repossessed, well, that means that Americans can no longer afford to make their auto payments. And the number one reason why they can't afford to make those auto payments is because they just don't have the money anymore. They now have to choose between making other payments like buying food and groceries or their housing payments. The reason for this is because inflation in the United States continues to go up and it continues to squeeze Americans' paychecks. And on top of that, those paychecks are not as big as they were in 2020 and in 2021. Sure, Americans may have gotten a raise over the last 2 years, but the big issue is that raise has not grown enough to meet inflation. If you got a 5% raise from your employer, that's great, but inflation is 9.1% right now, so you are still losing money. Meanwhile, everything else is going up in price. Car payments are usually the first thing to go when you're about to run into a recession or an economic slowdown because Americans have to have a place to live, so rent and their housing payment are something that they're going to focus on, but they also have to have food and energy and basic living expenses, so they're going to pay for those things too. But the car payment is something that gets sidetracked because Americans are going to push that off. The car payment is going to get pushed to the side because that is not a basic living necessity for a lot of Americans. And I know what you're probably thinking, Nate, how is it that a lot of Americans can't afford their car in 2022 if they got their car in 2020? If they could afford it back then, well, most of them probably have a fixed interest rate, so their car payment isn't going up. Why exactly can't they afford it today? Now, inflation plays a big role in that, but over the last 2 years, incomes were a lot higher for Americans. Remember all of those trillions of dollars in stimulus? Well, that eventually got trickled down to Americans, meaning that incomes eventually went up all throughout the United States. It was pretty clear for a lot of Americans that they could go out and get a car, and when you prove your income and the amount of money that you're making every single year to an auto loaner, well, then that's going to show them that, yeah, you can afford this car payment because you're making a whole lot of money right now. But these numbers were artificial. All of it was just stimulus money. It wasn't actually money that Americans were making on their paychecks. So incomes went up. They could initially afford a lot of those payments, but the reality is in 2022, as things get a lot more expensive and that stimulus money goes away, well, then Americans no longer can afford their auto payments, meaning that car repossessions are going up. For the month of June, they went up by around 4%, and now they're up over 13% year over year. Literally, I know people that have a $1,000 car payment right now and a monthly income of around $2,500. So they're paying most of their money on their car payment, and that just cannot continue in 2022. They have to now prioritize what they're going to pay for as we head into a recession. And the crisis does not end there because remember, these were loans that are coming from a bank or other financial institution. So what happens to those loans when the car gets repossessed or an American can no longer afford their car payment? Well, the bank has to somehow come up with that money. That's going to lead to a huge problem for the banks because now they're going to have to foot the bill for millions, if not billions of dollars worth of loan payments from all of these repossessed vehicles. What that's going to cause is a domino effect in interest rates. As the Federal Reserve raises its interest rates, well, now these banks have to get a lot tighter and be a lot more careful about who they give out loans to. They don't want to lose a whole bunch of money on a lot of these loans, so in the future, they're going to raise their interest rates because they're being a lot more selective on who can get a loan. You simply can't afford a loan if it goes above your debt to income ratio, meaning that by raising their interest rates, that's going to mean an additional $100, if not $200 and $300 and $400 that you'll have to pay just because interest rates are higher. higher. So if you can't afford it and if interest rates continue to go up, mathematically millions of people are going to be barred from getting an auto loan. This is a very similar situation to what we saw in the 2007 and 2008 housing crash. There have been a lot of subprime borrowers because money was really easy to come by over the last 2 years. Now we're running into a situation where millions of people can't afford their auto loans anymore, meaning we could see in the next few months a complete crash in prices and in the auto market. I will say if it does end up crashing, it's going to be a lot smaller and have a lot less of an economic impact on our economy in general, because the housing market, well, those loans and those values are triple, if not quadruple, the average car loan. So these are a lot smaller of loans, and they're not going to mean huge losses for banks or other financial institutions. And like I said, not a huge economic fallout for our entire country. But that doesn't mean that we're not going to feel something, and most likely we're going to feel something. And like I said, this is a really strong indication that we could be headed for a recession in 2022 as more Americans have to choose the payments that they're making. This entire situation could get a whole lot worse depending on the direction that our economy takes. Obviously, businesses, whether they're public on the New York Stock Exchange, private, or whatever, are struggling right now in the United States. They are having a hard time keeping the employees that they have as layoffs continue to grow all throughout the country, and there's just a lot less money circulating throughout the economy. Now, what that means is as more Americans lose jobs and as more Americans think they're going to lose their jobs in 2022, well, then they're going to have to prioritize once again. What do they pay for? Groceries and their housing, or their car payment? And eventually, what we can expect from the auto market specifically is that used vehicle values and prices are going to go back to normal. Simply put, as we are able to produce more vehicles and the demand for more new vehicles gets a lot stronger in the United States, well, then used car prices are going to go back down. The only reason they were so high is because it was impossible to get a new vehicle over the last 2 years. People were going towards anything that they could get, even if it was just a couple years old used vehicle. Eventually, though, the entire car market is going to go back to normal as far as prices go, and with fewer people buying cars in the United States, the entire car market is going to flip on its side. But now I want to hear from you on this issue. What do you think about the car market bubble finally popping in the United States? Do you think that we're going to finally see auto prices come down this year, or do you think eventually car prices are just going to go back up? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.